Hi, I'm Laurence Parker-Brown. Welcome to the Inside Network. Welcome to this INDepth for the Inside Network. Joining us today to talk about fixed income investing, we're joined by the Capital Group Fixed Income Investment Director, Haran Karunakaran. Welcome today. Now, we've seen some unorthodox central bank behavior. It's been quite an interesting year. How are you looking at the macro context of investing for advisors?
Yeah, it's definitely been an interesting year. Quite a lot of volatility in both equity and bond markets over the year. If we kind of zoom out and take the bigger picture, how I would describe it is we have a global economy that's going from very good to good. So it's slowing down, but slowing down in a way that's reasonable and shouldn't cause too much pain in the economy. And the positive of that slowdown is that inflation is also coming down, particularly in the US, where you see inflation was quite elevated a few years ago, and that's showing signs of an entrenched disinflationary trend at the moment. So overall, a pretty good picture. And in my world, in fixed income, a picture that's pretty supportive. We often talk about the stars aligning for fixed income markets today. That combination of slowing but still positive growth and inflation coming down is ideal for fixed income markets.
It's been such an interesting year for advisors and investment committees. I'd imagine that one of the key questions they're asking themselves is what to do about duration.
Yeah,
it's a conversation that probably has changed a lot in the last few months. Yeah. What guidance would you offer them at the moment?
Yeah, it's definitely very topical. And I think it's one that, I've certainly been having conversations with our clients for a good 12, 18 months now. I guess it's important to understand the context of where investment committees and advisors are coming from. And that's, in Australia in particular, over the last decade, a real shift away from duration. Duration was almost a dirty word in that community. And instead, many clients were shifting from traditional bonds towards floating rate credit, where they weren't exposed to duration, and in a zero rate environment ended up shifting further and further out the risk spectrum to earn the rates that they weren't no longer getting. So, into high yield corporate bonds, into kind of niche areas like securitized credit, and more recently, private credit is the sort of flavor of the month. But I think what's important to recognize is that context has changed dramatically. So we're no longer in an environment of zero rates. Like the opposite, yields are at near historic high levels in recent history. So that really changes the calculus around duration. Firstly, with yields being higher, duration actually compensates you for something. So you can earn an attractive return. So that's a big tick. Secondly, when rates are high and inflation's coming down, that means rates are likely to come down in the future as well. Different paces in different parts of the world, but that down cycle in rates creates a lot of opportunities. It drives capital gains on bond investment. So duration will potentially have an additional tailwind to returns over the next few years. And lastly, I'd point out that the main reason one invests in fixed income is for a defensive allocation in the portfolio. When rates were at zero or yields are very low, that defensiveness kind of disappeared. It's hard for rates to go any lower, or in other words, for the bond prices to go up when equity markets sell off. But now when your starting point is 5-6% yields, there's a lot of room to go down and a lot of room for bonds to rally when equity markets sell off. And, in fact, we saw that recently in August. There was a mini stock market correction, recovered pretty quickly. But in those couple of weeks, bonds actually did quite well. They had that negative correlation to equities, which we're always looking for. Hadn't been there for many years, but seems to be back now.
You touched on the stars aligning and a complete reset in the terrain for fixed income investing. I'm interested, given that you can look across at so many different sectors and types, where do you see as the most attractive space for allocating capital?
Yeah, I think for us, it's probably the credit market today. If I think of the trade-off between the defensiveness that we spoke about and the return potential, I think higher quality credit in particular provides that sweet spot. Diving a bit deeper as we look across the main sectors of the credit market, I think investment grade credit is quite attractive today. It is more defensive because they're high quality credits, very low risk of default. So a good ballast in a client's portfolio. And today they're yielding on a global level about 5.5%, which is an attractive return. Going out on the risk spectrum into high yield credit, emerging market debt, the total return, the total yield levels are still pretty high relative to historical levels, but credit spreads, the valuation component has tightened quite a lot. So I think there you're probably getting a bit less compensation for the risk you're taking on. So we tend to be underweight those areas, overweight the higher quality portion. Securitized credit is another area that we find very interesting. It's a niche sector, so you have to be more cautious in how much you allocate there. But if you have the capabilities to really analyze those bonds and look through to the underlying collateral that sits beneath them and make sure you know what risks are there, there's a lot of return opportunity to be had there.
You touched on the spreads. Now, there's a lot of demand to look at credit at the moment. Now, should that be domestically, the US? You touched a little bit on the geographies, because those spreads are different in different markets.
I would look at it from a holistic perspective, not just the spread component, because I think what matters the most end clients and investors is really the total return they're getting, along with the risk characteristics they bring to a portfolio. When you take it from that perspective, I think total yields on global investment grade credit, so global IG, is near the highest it's been in over a decade. So very, very attractive there. As I mentioned earlier, about 5.5%. And that yield is a pretty good projection of what you're likely to get in terms of total return over the next 5 or so years. So global IG, I think, is quite attractive. If you look specifically at spreads, I think it's very variable across markets and across sectors, and actually across companies as well. So we talk about dispersion in valuations between different bond prices, and that's reasonably elevated at the moment, which for an active manager like Capital Group is great. It means we have the opportunity to go in and find these undervalued bonds that are out there, bonds that we think will go up in price. So you're sort of earning the yield, but also getting a capital gain from buying the undervalued bond, selling it as it goes up in price.
You touched there, as an active manager, you're looking across all the different opportunities. For an advisor that's talking to clients, that's trying to build a portfolio and explain it, could you touch on some of the key messages? And I'm also particularly interested, you touched on not only the defensive qualities, which are back now, but also the income, what's realistic, what should they be hoping to achieve?
I think it's a really interesting time for fixed income markets at the moment. We invest primarily in global universe, which covers Australia, but it's a bit more focused elsewhere. But I think as I compare the two, I think on the margin where I would be adding today is more offshore than onshore. And the reason for that is if the duration side of things. As rates come down, the central banks cut rates, bonds that have duration, any fixed rate bonds, will benefit from capital gain. But to capture that benefit, you have to invest in the markets where rates are coming down. And based on what we see today, that's much more likely to be in the US in a more meaningful way over the coming years. So global, US-oriented and global bonds, I think, over Australian bonds makes a lot of sense. I think investment-grade corporate over, say, sovereigns probably makes more sense. If I look at investment-grade corporates over the next few years, I'd be pretty comfortable with an expectation of sort of mid to high single-digit returns, which is, to be clear, very unusual for a defensive asset. But if you look, we've done some work looking at past rate cutting cycles, and what it shows is that in the 3 years after the last rate hike from a central bank, investment-grade corporate on average returns 10% per annum. We're about 12 months into that 3-year period so far, and running at about 8% now. So really along line of that picture. But I think how you could think about it in a really simple way as an advisor is, your starting point is a 5.5% yield, potential 1% on top of that from active management, finding those undervalued bonds that we talked about, and a potential 1 to 2% on top of that again from rates coming down. So all in, you're pretty comfortably talking about kind of 7 to 9% returns over the next few years.
Pretty interesting returns. A final little thought, markets are forward-looking, advisors working with clients, particularly retirees, they want to hopefully support a comfortable lifestyle for a long time.
Yeah.
What could be the triggers for a change? We've got a US election that's very prominent. We've also got central banks reviewing where they are in their rate decisions. What could change the equilibrium?
Yeah, it's an interesting one. I mean, US elections are very topical at the moment. The studies looking at empirical data for fixed income show they actually don't have a huge impact. What you tend to see is a rise in volatility in the couple of months leading up and the couple of months after. But ultimately, what drives fixed income markets are inflation and growth dynamics. I described earlier what we see is a pretty benign outlook of low growth and inflation coming down. The bigger risk to that, I think, is probably a risk of a recession. That's something that we're thinking about more and more. As the economy softens, naturally the risk of recessions go up. It's not the dominant case, but it's a risk that we think about. In that environment, actually, fixed income does better, and that's why you want to hold fixed income, because in that environment, the Fed and other central banks will likely cut rates more aggressively, and that boosts fixed income returns even more. The sort of tail risk that's negative for fixed income, I think, is if inflation suddenly comes roaring back to life. And I describe that as a tail risk because really at the moment in the data we see, there's nothing that indicates that could happen. It's always a risk that's out there, something that is in the back of our minds, something that we're watching for, but not something that we see on the near-term horizon.
A golden age for fixed income investing. Thank you so much for your insights.
Pleasure. Thanks for having me.